Hey Dad, it's Jim. It's Friday morning. About 3 hours before you're not going to have a lunch. I'm looking forward to it. This is really short. I'm going to try to keep it under 10 minutes, maybe even under 5. I just wanted to show you a chart of the 10-year bonds and what it's done the last couple of days, which is nothing short of spectacular. Look at this drop in the last 3 days, and that little green bar down there is this morning's action. And I noticed a relationship, and I pulled up some really long-term charts to show it. Well, actually, let me show you where I first kind of noticed it, and that's on this monthly chart. I noticed where we made lower lows here in 03, and now again in 08, and then back in 98. And I thought I'd try to get even more data, so I pulled up this chart from a different program. This is the same index, and I'm back now to 1971. And this is a line chart. And this can kind of, you remember these days, back when interest rates were up in the low 20s, high teens, and here we are now with the lowest interest rates. Well, certainly as long as from 1970 to now, this is the lowest they've been. And then here's a chart of the sp500 going back that far. And let's look at some points where we put in these lows real quick, and then we'll be done. I'll have a drawing tool. Okay, like that. And note, let's go back to 98. So there's that right there. Nice arrow, huh? A low at the end of 98. This is a monthly chart, okay? And then let's bring in the SPX. And if you recall the long-term capital scandal back in 98, back into my chart. Bear with me. Why won't it let me do this, Dad? This is irritating. Stop drawing. Let's try that with the escape button. I'm going to hit the escape button. Sorry, these are unscripted little things I do. Alright, so here we go. Now, if that got rid of my chart again, I'm not going to be happy. How I can do that? Bear with me. Here we go. Alright, long-term capital scare back in 98, right there. Okay? Now let's move forward to our little low in 2002. Alright, so there's a low in 2002, and then we put in yet another low in 2003. This is the 10-year bond again. And then let's bring back the S&P, and what happened? Well, you know what happened in 2002. 2003. We put in these lows. Okay, I could go back in time and show you other examples of this. Now, just because it's happened in the past doesn't mean it's going to happen again, but as everyone loves to quote Mark Twain, history doesn't repeat, but it often rhymes, or something to that effect. So here we are in 2008, and we're putting in a lower low. And we look at this chart at a very unprecedented drop, but then certainly showing no signs of bottoming. However, it stands to reason that somewhere down in this range we're going to be finding some kind of bottom. What's the bounce going to be? I don't know. And since we're putting in a mega M top, if we close below this on a monthly basis, now that hasn't happened yet, we got a whole, if we don't close below this point on a monthly basis, then this line won't be down here, right? This line only prints the closing price for the month. I mean, obviously it's intramonth, so it's showing it to us, but it could be that this line will end up here for all we know. Who knows? But let's assume we close down here at the end of the month. And my assumed path is, once it stops going down for a while, then it's going to come up. It's going to at least test this area probabilities, say. Well, nothing's guaranteed, we know that. Or it could go back up in here. And then the odds of it staying up in here are not great. Anything can happen. You could get a V bottom, but not likely, And we could turn back down and test down here again and maybe even go lower with time. But this could be a really nice bounce in here or not. This sort of violent reaction down, we could get a violent reaction back up before going down again or stair-stepping, or we could end up in one of these extended periods of just exhaustion. Everyone's just so beat up about the markets they just don't even want to deal with it. Things just look so volatile here. It's hard for me to believe that it's going to simply go into a muddling around phase. Anything's possible. But the main thing I want to say is it appears to me that the stock market starts advancing before the bonds bottom out. And really, if you think about it, bonds are the last bubble to not have burst. So at some point it's going to burst, and the vehicle, I think I've mentioned this to you before, and it's in that other video I played for you, I made for Michael and shared with you. But at some point, this TBT is going to be a great investment. Timing it is a whole other thing, and there's certainly nothing in this chart to me that says buy at all. In fact, just the opposite. This is still saying short rallies. So I just wanted you to see that. I hope I've shown it well enough. And just to reiterate that there are points where these bonds hit extremes that mark periods of prolonged upturn in the markets. And just going back to the S&P chart, you can see that in the 80s, these correspond with bonds hitting lows. And when I say bonds, I'm talking about interest rates. So, timing this, nothing easy about it, but if history rhymes in this case, the market should turn back up, and as it does so, bonds should bottom out. Where, we don't know. But I mean, honestly, how low can they go? I hate asking that question. but really, I mean, how low can they go down here? How low can interest rates go? I guess we're going to find out. But I wanted us both to keep an eye on that. And take care.